Before we go further, I just want to stop for a moment and talk about methods of accounting. Now, just like there are different types of entities that financial statements are prepared for, there are different methods of accounting. The most simple method is the cash method, and then there's obviously the accrual method. The cash method is regarded as the simplest, primarily because it is nothing more than recording receipts that are received and then recording expenses that are paid. It is simply a summary and transactional analysis of checks going in and out. Now, obviously, there could be other reasons for having cash coming into a business. It could be the issuance of stock. It could be the obtaining of a loan. It could be a loan from a bank. It could be a loan from a stockholder. That's really irrelevant. But a cash basis entity is very simple because it only records those transactions as they apply to money coming in and money going out. On the other side of the dime, we have the accrual method of accounting. And the accrual method of accounting is a little different. Under the accrual method of accounting, income is reported and recorded when it is earned, regardless of whether the money is received or not. Expenses are recorded when the expense is incurred, regardless of whether it is paid or not. So you can see by these two definitions, the simple definitions of a cash basis taxpayer and the simple definition of an accrual basis taxpayer, you can see that the same business under two different methods can obviously have a different result. So, what is the business supposed to do in choosing a method of accounting? Well, first of all, they make it rather simple. And when I say they, I'm talking the Internal Revenue Service for tax purposes and obviously the generally accepted accounting principles that's promulgated by the American Institute of Certified Public Accountants. A cash basis taxpayer is generally a service business, like a law firm or an accounting firm or an engineering firm or a medical practice. Those types of businesses generally use a cash basis of accounting. However, if you're in the type of business that has inventory, then you are required to maintain an accrual-based accounting system. That means that the income is reported when it is earned, whether it's paid or not, whether it's received or not, and expenses are deducted when incurred, whether it's paid or not. The reason for this distinction is because businesses that have inventory, the object is to match the revenue with the expenses. So there's probably the concept here is that there's probably more of an ability to manipulate the income of a business that has inventory if it uses the cash basis method instead of the accrual basis accounting. Okay, now that we've talked about that, let's just mention a couple other things about financial statements. First of all, financial statements come in three different forms. Financial statements could be compiled, they could be reviewed, and they can be audited financial statements. And when we talk about these different types of financial statements, we're really talking about the type of work that the accountant had performed in assembling the financial information. Now, a compilation is nothing more than when an accountant takes the information from the business and puts it in the form of a balance sheet, an income statement, and possibly a statement of cash flow. The accountant provides no assurance that this information is correct. In fact, if you were to look at what we call the opinion letter, which is attached to the financial statements, the compilation strictly says that this information is the representation of management, and we, meaning the accountants, provide no assurance as to the credibility or correctness of this information. On the complete other side of the barometer is an audit. An audit is a financial statement in which an accountant, an accounting firm, has performed the necessary tests to determine that this information is true and accurate, and it does not have any material defects. Now, when an accounting firm performs an audit, they have to perform and follow certain procedures in accordance with not only generally accounting principles, but general accounting auditing standards, generally accepted auditing standards. Frequently, when businesses require loans and the lender wants some credibility to the financial information, they'll require business to provide an audited financial statement. Somewhere in between, there's what's called a reviewed statement. And a reviewed statement does not provide the same level of assurance of an audit, but it certainly provides more assurance than just a simple compilation. And although the tests of the accounting records are not as sophisticated and thorough as an audit, an accounting firm that prepares a review statement obviously is required to perform some tests that the information is not materially incorrect. So there you have an audited statement, you have a review statement, and you have a compilation. Now, depending upon the type of statement that you are looking at, you may or may not see supplemental schedules and footnotes. Let's talk about supplemental schedules for a moment. When we're looking at an income statement and we have sales, cost of sales, gross profit, from that gross profit you'll see selling and selling expenses. Then you'll see general and administrative expenses to come out to the income from operations. You may well find that within financial statements there will be a separate schedule providing the different accounts that comprise selling expenses and then obviously general and administrative expenses. In those instances, the income statement is expanded to multiple schedules and multiple attachments. This is to aid the reader in understanding the components of the income statement. Okay. In addition to the income statement, within the income statement, you may also find footnotes. Footnotes are very, very helpful because they are in narrative form providing an explanation as to the history of the business, the process in which the accounting records were prepared, as well as identifies significant descriptions of transactions or accounting procedures that were used to develop this whole package. Frequently, you'll see audited financial statements having a full detail of footnotes. You know, when I lecture at New York Law School, I often tell the students that I compare the footnotes to the sports pages of the newspaper. I always read the sports pages first because basically that's what I'm interested in, and when I work backwards it allows me to go through them, and then I read the box scores and whatnot. Well, when I read a financial statement, and I'm going to suggest this to you as well, I would read the footnotes first. Because when you actually read the footnotes, you get a clear understanding of what the business is all about. Is it a complete history that is encompassed in like an annual report or maybe a 10K? The answer is obviously no. But it certainly gives you enough information that will allow you to understand the accounting policies, the procedures, and the type of business that you're looking at. With this background, now let's go back to some of the elements of the balance sheet and income statement to try to gain a better understanding of where we stand and how you can use this information to practice law. By the way, I often say that accounting is the language of business. So even though you're not an accountant, and probably thankfully so, you really want to be able to know this language because it makes a lot of sense, and your ability to understand these concepts certainly will help you service your clients. Now, we said before that the current asset section of the balance sheet provides those accounts that are the most liquid. And again, just to summarize, we said they were cash, accounts receivable, inventory, prepaid expenses, and other current assets. These are current assets, again, because of their liquidity. But more importantly, you have to remember that accounting is a historical exercise. And so these accounts on the balance sheet, whether they be the current assets, or even the fixed assets, or the intangible assets, which also include the long-term and non-current assets, are recorded at their cost. So when someone buys a widget to sell, and they don't sell all their widgets, they buy 100 widgets, they sell 80 widgets, and they have 20 widgets left over, that ending inventory is on the balance sheet as a current asset at their historical cost. Now, this sometimes is problematic for attorneys, because attorneys, like many people, they understand that this asset, this inventory, is going to be sold for a certain amount of money. And obviously, it's going to be sold for an amount greater than what its historical cost is. Therefore, you have to keep in mind that when you see inventory on a balance sheet, it is clearly at its historical cost. In fact, you can apply that concept to accounts receivable as well. When you are in the business and you're selling a widget, and you are in fact required to keep your books and records on the accrual basis of accounting, that amount of sales that you have recorded, that you have made and have recorded but have not yet received, is your accounts receivable. So that means that you're going to receive that money sometime soon. Therein lies an additional problem. We frequently look at supplemental accounts receivable aging schedules as a management tool to understand the accounting process and the accounting records of a business. And these aging schedules provide a summation and a division of these accounts receivable by day. For instance, if we made a sale today, it would be under the current section. If we made a sale 30 days, it will be in the 30-day section. If we made a sale and we have not yet received the money, it would be within, and it's been 60 days, it would be in the 60-day section. In other words, the longer, the aging schedule provides an analysis of this accounts receivable. By its length, it's still unpaid or not received. Now, you probably know the old saying, a dollar today is worth more than a dollar tomorrow. But more important to that play on the present value concept, what you have here is that from a pragmatic point of view, when you have an amount that's recorded as accounts receivable, you've made a sale, and 30 days have passed, and then 60 days have passed, and 90 days have passed, the longer this accounts receivable is outstanding, the more likely you're not going to collect this money.